The broadcast is now starting. All attendees are in listen-only mode.
So good morning, everybody. Good morning, everybody. Thanks so much for joining us as we continue our In the Trenches series. We've got about a minute or two before the top of the hour. We'll be starting here shortly, but thank you for joining us. Well, good morning, everybody. I'd like to welcome you back to our ongoing weekly In the Trenches series as we work with financial institutions responding to the COVID-19 pandemic and the compliance and regulatory obligations in the wake of COVID-19. Today, you've got the regulars. So this is Brad Rustin. I'm joined by my partner, Craig Nazaro, also on the financial regulatory team. And today we're talking about an interesting topic, especially since as of yesterday, a number of our institutions have received notices scheduling exams that are coming up. The CFPB has begun scheduling compliance examinations again, so a number of folks likely got letters yesterday relating to that. And then the Federal Reserve as well as the FDIC have started to schedule exams and begin exam cycles again. Specifically as those regulatory agencies begin to come out of the COVID-19 shutdowns, or at least the limited operational capabilities as part of the COVID-19 pandemic. Yeah, as we think about that, what we're specifically talking about today is how are you going to start preparing for your upcoming examinations? What are certain things that we believe regulators are going to be looking at as they examine how you responded to COVID-19, how you responded to the economic changes of the last few months, and ways that you can proactively prepare your institution to really show off how you address these particular concerns. Obviously, overnight, we had massive changes to how every financial institution conducts its business. Largely all of our proactive plans, the ways we were thinking about product offerings, the ways we were thinking about services, the ways we were thinking about, or even something as simple as the interactions we have with our customers changed and largely became reactionary. We were rolling out PPP programs in real time as regulations continue to change. Many of you are working right now to roll out your Main Street lending programs as those regulations continue to change and adapt to try to address these issues. And then generally, we're working with customers to try to adapt to their unique financial considerations, meaning those individuals that may have been furloughed, lost their job, maybe in shelter-in-place organizations. And so, one of the things we learned from the recession of 2007, 2008 is that there is, to a certain extent, a tone shift that occurs after this. And what we mean by that is at the height of the Great Recession, particularly in the mortgage industry, regulators were being very accommodating, looking to institutions saying, we understand you're trying to be responsive to customers, doing everything you can to help. But then that shifted as we started to move further and further out from the triggering event, and there was some regulator amnesia. And so what we're trying to drive home today, and we'll talk about different aspects of this, is though there is ongoing guidance, encouragement to respond proactively to COVID-19 pandemic and the impact it's having on customers, remember that at some point the tone of the regulators will change. And so as we talk through today, we're going to talk a little bit about how you should be thinking about safety and soundness in the wake of COVID-19, what the Bureau has indicated is their new agenda. We'll touch briefly on PPP just because it's become such a hot button lightning rod issue at the moment, and certain regulatory focus we may see related to that. And then we're going to end with talking a little bit about what your regulatory risks are, how you can be thinking about your compliance management system, your enterprise risk management system, updates you should be doing to those in the wake of COVID-19. And then very briefly, we'll touch on planning for how this potentially could play out, particularly if there is a change in administration in 2020 and some of the, at least indications at this point of where a potential Biden administration may go from a policy standpoint related to the financial services sector. So with that, I'll turn it over to Craig, who's going to kick us off here talking a little bit about pandemic response.
Thanks, Brad. Good morning, everybody. The one thing I think we would like you to walk away from this week's In the Trenches would be how you're viewing your exam strategy coming up, or how you're reviewing your exams to proceed when they get scheduled. You're going to have to show movement and evolution. The last thing you're going to want to do is have a regulator come in there and have the controlling documents, controlling programs look substantially similar to what they've been looking at year over year, and have them, questioned how you were proactive and how you avoided being reactionary to a lot of the challenges that were, coming in almost on a daily basis. So here we're asking you to start with looking at, what you've done over the last 3 to 4 months as the pandemic has evolved. Have you moved originations, your deposits, and/or servicing functions to a digital channel? Are you planning to move to a digital channel over the next couple of months? We're going to have to look at what controls we put around that, how we vetted it, how we're deploying it, and the regulator is going to be hyper-focused on it. You're going to want to look at it if you reviewed or updated your 2020 strategic plan in any significant manner. Most of us had plans in place in the fourth quarter of 19 for 2020 that called for organic growth. We were in a completely different economic environment. Everything has shifted drastically. It normally doesn't shift this quickly. Did your strategic plan project rising defaults, or were you projecting, slow growth in a rising rate environment? Now find yourself in a lowering rate environment. The call for growth through M&A. Are you going to still do that? Are you going to change your M&A growth strategy? Are you going to look for new opportunities as the market shakes out? Have you paused to update your disaster recovery response to COVID-19, or your general response to COVID-19, and continually monitor that and update it as you learn new things, as guidance is rolled out? You're going to want to look at your disaster recovery plan from last year, see how you fared with that. Take this as an opportunity to improve that, to update it, to see how it looks when you have a real world shift to work from home or stay-at-home order, and show the regulators that you're hyper-focused on that issue of things as well, and those controls. Did you participate in any programs that weren't necessarily in your wheelhouse? We saw a lot of banks try to take the opportunity to get the origination, the fees in the door from the PPP program. A lot of our clients were successful with that. But if it was outsized to your normal scale in small business lending, did you scale up your controls around that? Are you properly documenting that? Main Street Lending Program is another example. We're going to talk about that later in the deck, but it's something that you have to put into this idea of pivoting for the pandemic, and how you're going to create that narrative for the regulators to see how proactive you are. Another one is your compliance management system. We're going to touch on that greatly, but did you update it accordingly? It should not. Your CMS should look nothing like it did a year ago at this point. The regulator is going to be looking for significant change. They're going to be looking for how you are managing that, and they're going to take that into account when they look at how you're posing a risk. They have a risk-based model to review your institution. So, like, if your CMS is not evolving, your risk is significantly greater than your peer who has a CMS that was evolving, in real time, along with what we were seeing in the market. And then third-party oversight. What did you outsource any functions that were out there that you normally wouldn't do? This goes back to the first point. If you're moving to a digital channel, are you going into spaces where you're going to be working with vendors that you're not necessarily used to? Regulators are going to want to see SMEs assigned to that, and how you're dealing with the new challenges that can arise with new third-party partners, new vendors that you're looking to leverage for new customer access to your products and services. Brad?
One interesting thing here to note as well is, the key takeaway you're going to hear throughout today is make sure right now you're in the process of updating. The last thing you're going to want is 4 months from now, 6 months from now, 8 months from now, an examiner to be working with you. And as Craig noted, everything looks the same. The face of the financial services sector has changed dramatically in the last 3 months. And if there's one overarching concern we're going to try to drive home today, is that you need to adapt both your risk management systems, your compliance systems, as well as, in essence, how you conduct banking to respond to the changes that have occurred over the last 3 months. When we think about that immediate response, we can look back to some of the guidance that came out initially from the prudential regulators. They were saying, we want you to be proactive in addressing the needs of impacted communities. And one thing to remember is that also plays into your CRA ratings. CRA can extend to any federally declared disaster areas. As it stands right now, almost every part of the United States has an existing federal disaster declaration. And so your efforts to serve customers in those areas, in essence, anywhere in the United States or its territories, can be counted for CRA credit. In particular, and one of the things we'll talk about is the OCC really driving this home, is to the extent you are working with LMI, low to moderate income, census tracts or areas that may be within your assessment area, you can also receive credit there for different things you have done to accommodate the needs of those communities during the COVID-19 pandemic. We think about what regulators were saying, and we've just listed here, for instance, what the FDIC had listed. Different things you could have done to be responsive to customers. And what I really want you to gain from this slide is, all of these are very pro-customer changes. A lot of these were instituted unilaterally by a lot of financial institutions in order to help those customers. But just remember, as you think about that, at some point, we've got to unwind these policies and procedures. We've got to start looking now towards long-term safety, soundness, and financial condition of the institution. At the same time we're looking at this, when we're going back now 6-8 months from now, it may not be something as simple as saying we waived these things. Instead, the examiners are going to be looking at, how did you waive it? How did you think about it? How did you undo those changes? And how is this now impacting the overall safety and soundness of your institution? Meaning, did you go too far? Because we think that regulator focus is going to be shifting from immediate crisis response over to something more broadly, which is, how do you balance the needs of customers against the long-term financial health, stability, safety, and soundness of your institution? And so right now you need to be planning and thinking about, okay, if your institution did make these changes, how are we going to unwind them? And how do we think about those globally as we start to think about how we're going to gain revenue for the institution? How are we going to continue to operate? Because as we'll see later, particularly in this very, very extreme rate environment where rates are near zero at the Fed, not a lot of margins right now on mortgages, not a lot of margins right now on auto, not a lot of margins in many areas of consumer lending where you could typically make some sort of interest revenue. The question is, how is your institution in the next 9 months going to continue to operate, generate revenue so that it can stay operational in a safe and sound manner, particularly as there could be a significant disjoin between the financial condition of the institution, the financial condition of the customers that are actually using the institution.
One thing I want to also note there, Brad, is that Brad's talking about how you're going to unwind these policies, like all the bullet points that he has up there on the slide. This is another point where you're going to have to anticipate the shift in regulatory tone. Right now, you're seeing all guidance. At the next slide, we're going to discuss some of the guidance that we talked about yesterday or 2 days ago from the joint agencies. But they're all saying, we'll work with you. You should be working with the consumer. You're out there trying to burden the financial, unwind the financial burdens on your consumers and help them through the pandemic. And you're doing that. You're waiving the fees. You're getting the CRA credit. Just like we saw in 2008, you're doing it at the behest of the regulators, at the request of the regulators. And then when you unwind these programs and you put them back in, suddenly the regulators are going to come back in and start, hitting you with UDAP findings. I was stunned in 2011, 12 when we were coming out of the Great Recession, especially in the mortgage market, like Brad was saying, that the regulators were even trying to say that stuff that we put on credit reporting holds or forbearance agreements, and you were getting the findings from the regulators as you were reinstituting your old policies and procedures to the individual consumers. I just want to point that out. This next slide here is the guidance that we saw, I think, come out on the 23rd from the joint agencies. The FDIC, FRB, OCC, and NCUA released this. I have certain pieces highlighted. I've been reading the regulation, the guidance that comes out from these regulators as, to kind of like read between the lines. Most of it is, we're going to give you the benefit of the doubt when you're, as to the supervision and the flexibility that is going to be needed to manage the pandemic. That's all good. I'd like to hear that from the regulators, but I like to focus on the language that kind of give their true intentions, like that first bullet point there. Even when an institution management has appropriate governance and risk management systems in place to identify, monitor, and control risk. So they say that they're aware of the COVID-19 impact and how it can adversely impact the institution, but the underlying thought is there. They expect you to have an appropriate governance system, an appropriate risk management system in place, regardless. And then, even if that was there, maybe if it was under stress from COVID-19, but that's all going to go away. In 12 to 18 months when they're back on site, it's not going to be, well, we understand that you were responding quickly and over those 3 months. That's the best thing you can walk away with is don't let your senior management teams, your business units kind of drive the narrative of, well, what do they expect from us because, we're trying to react to this national health emergency. They expect proper compliance, and they're going to forget that it was a national health emergency in 12 months. That's their third to last bullet point there. Examiners will consider whether institution's management has managed risk appropriately, including taking appropriate actions in response to stresses caused by COVID-19 impacts. They're basically saying, like, look, we want to see how you're internalizing the impact to your institution, how you're in real time managing the shift and the changes that we're seeing in the economy, in the regulatory guidance that's coming out on a daily and weekly basis. You're going to want to document that. They're basically saying the EICs are going to be in there looking for it. You want to start to stock your policies and your programs with examples of how you did just that, how you responded to COVID-19. You don't want to explain it verbally. You don't want to say it, well, it was living in our emails. We were having meetings. We don't have minutes from those meetings. You want to be able to produce a document that says, here you go, and kind of allow them to answer that question themselves when they're going through all the requested diligence before the start of the exam. Next page, Brad.
And so as we think about what's going to be coming in the near term, I want to talk about these next two slides together because I think it is very insightful. If we look historically, if you've never used it, St. Louis Federal Reserve has great long-term economic data, but I pulled these together through the St. Louis Fed. And what I want to drive home here is if you look at unemployment, which is the light blue line that's a lot more jagged than the other, what we see is that unemployment in essence acts as a leading indicator for delinquency rates on other consumer lines. Kind of makes sense to us. But what we also see is if you start comparing what happens, well, when we have unemployment spike, there's almost an immediate increase or a very near-term increase in delinquency rates on credit cards. And then shortly thereafter, we see mortgages start to follow behind. Then we see leases, consumer loans all start to follow. And so if we're thinking about the challenges to our near-term economic stressors to our institutions, we need to be thinking about these various loan lines and how they're going to be impacting our institution, particularly if we see significant defaults. Now, remember how we kind of trace these, looking at the recession as to what leads what. Now, if we look and break down actually into the first quarter of 2020, we see obviously a significant increase in the number of forbearances. We've got the chart there from the Mortgage Bankers Association showing that somewhere between 8 and 10% of mortgages right now are in forbearance. That's significantly less than the current unemployment rate, so very good news for the industry. But as we saw in the past picture, some of that may be as a result of accommodations. We've seen some leveling off on the number of forbearances, so good news there as we move forward week by week. The latest that MBA has published is the May 25th week, and so we've seen that level off somewhat. Perhaps, though, more troubling is when you actually go into the Federal Reserve Bank of New York's data on delinquency. Remember how we said credit cards tend to be a leading indicator. If you look at that dark blue line with the red arrow next to it, that's credit card delinquency rates. And so as we moved through the first quarter of 2020, we started to see that spike starting to occur already. And the question is, how far does that go? And does it get all the way back to what we saw in 2009, 2010 at those peaks where we're having credit card delinquencies in 13, 14% range? Similarly, we continue to see, and this actually interestingly occurred previously in all 4 quarters of 2019, there were increases in auto loan defaults, but those continue to increase. So if we're thinking about leading indicators, we as institutions need to be prepared for the fact that we may start to see a sequential increase in the number of delinquencies as we move across the different business lines within the institution. Really credit cards, auto loans can serve as that bellwether that eventually will begin to show mortgage and HELOCs, which tend to lag a little bit further behind. But, when we're looking at, various computations of real unemployment being in the high teens or potentially low 20s, depending on how you calculate it, particularly in July and August, once some of the CARES Act stimulus payments begin to wear off, meaning the PPP program will have been fully dispersed with no additional sources of revenue for small and medium businesses. The supplementation to income under the unemployment programs will begin to wane. We may see these numbers really start to spike. So as you're planning and beginning to think about what your institution is going to be doing in the next 30 to 90 days and what you need to document for regulators, be thinking about we're monitoring defaults, we're seeing it occurring in the industry, and we're beginning now to prepare to respond to it.
And Brad, I'd like to add there, we're talking about that. A lot of the clients take these slides or these metrics to be only applicable to their credit risk silos. Their ERM and their credit reporting committees or their risk appetite committees are looking at the data, for the safety and soundness purposes of how strong their portfolio is from a credit perspective. What I would like people to start to do or to be aware of is how you can use this data to be a little bit more proactive, just on the compliance side in general and away from the credit silos. You have all this data and you know that where the credit markets are going, where the delinquencies are going. So that should inform your CMS. We'll talk about that a little later in the program again, but this data is not just applicable to your credit risk and your safety and soundness controls. It's applicable to your consumer compliance controls as well. It should be driving your monitoring and testing programs. If you had a schedule that was applicable in 2019, as this data is released, it would be prudent to show your consumer compliance regulators that you're internalizing this data and your control departments, your credit risk department is working hand in hand with your consumer compliance department, and you're anticipating, more problems to start to spike in your default areas, in your default servicing areas, or your customer complaint response time. So you should be looking to kind of tweak that now, be proactive, scale those monitoring testing reports in your default spaces. Start to allocate more QA and QC time to your complaint responses, because that's coming. You can see the wave coming, from the shore, and the regulators would like to see that your program works in a way that's dynamic enough to account for that. This next slide, again, speaks to your credit risk. So we had the guidance come out back in May from the FDIC FAQs that spoke about how do you clarify, how do you account for TDRs, and if you have to put assets that are defaulting under a TDR aggregation if it's related to COVID-19. And we have the 3 metrics there as to say why you can't. But you should be able to document, and your management team should be able to show how they were closely reviewing the loan processes, how they were monitoring where the designation of TDRs were coming from. If you have a large bubble that's building up that's not currently structured as a TDR, kind of be talking about that now, so you can show that you were aware that it was coming, you were aware that these will eventually be moved into TDRs. As the pandemic lengthens and the stay-at-home and shelter-in-place orders were extended, the guidance almost becomes not telling the intended purpose of it. They were looking at this when it was written as, how do we avoid the banks taking all these hits on TDRs when the economy is going to bounce back after 2 to 4 weeks? And the guidance was written as such. So be aware that when they put this out there, they weren't intending for the default to remain into the fall, into the third and fourth quarters of 2020 and into 2021. You should be bouncing past that guidance. Go ahead, Brian.
Yeah, and two, make sure you're keeping good documentation, meaning, if you're going to claim that items that should otherwise be classified as TDRs are not, make sure you're going to keep that documentation to show exactly the criteria were met that were set out in that guidance, meaning you spoke with the customer, it's related to COVID-19. It obviously you should be able to demonstrate that the loan was not more than 30 days past due as of the end of 2019. But then really it's also this kind of long term, which is very similar to what we were talking about with the immediate COVID-19 response. But if we talk about what regulators are now expecting is they want to see that you still were making these determinations with an eye towards prudent, safe, and sound banking practices, and make sure you're documenting why you thought it was viable long term. Because what you don't want to do is just simply have kind of blanket policies that said anybody who said they had a COVID-19 problem, we simply placed them on non-accrual, or we extended their payments and capitalized it to the end, or whatever the case may be, and then claim that you don't have to show those as troubled debt restructurings. You really want to be able to document that you exactly fall within this guidance relating to the TDRs, and then as those circumstances change, you managed your way out of it in a safe and sound manner with an eye towards prudent banking and underwriting standards as you move forward. And then, when we talk about what examiners are going to be looking for as we go into this exam cycle, be thinking about how you're going to present your institution. Are you still running the same committee meeting cycle, board meeting cycle, management meetings that you were running pre-COVID? And I think there's going to be a pretty large expectation from examiners that there's going to be some sort of change to how you are conducting business, how you are running your oversight. Similarly, and I think Craig touched on this a few minutes ago, is if you have repetitive board meeting notes, repetitive loan committee reports, repetitive compliance reports, I think examiners are going to look very poorly on that because they're going to see that you weren't adapting to a changing climate. I don't know that anyone's going to dispute that the world of banking has changed dramatically in the last 3 months, and they're going to expect there to be changes in how you ran your committees, how your board was consuming information, what your management response has been. Make sure you're specifically including information on how you're responding to COVID-19. We've seen some institutions going so far as to actually adding COVID-19 updates to their board meeting minutes or their committee meeting minutes or their executive meeting minutes so that they can then demonstrate to their examiners in the future that, no, we were specifically addressing this. We want you to see this is different, this is new, this is responsive. And then similarly, make sure you understand if your committees, particularly committees of your board, have the requisite expertise to really understand what it is they're seeing. Anytime you have this type of external crisis to a financial institution and you're going to be responding to it, make sure that the people who are overseeing your institution's response, who are overseeing how you're adapting to this changing credit environment, make sure they have the expertise or go outside and try to find it. At the end of the day, those examiners are going to look for active leadership that changed in response to the crisis and that you are maintaining safety and soundness through this. Just like Craig said, if you read between the lines of all the guidance that's coming out, the idea is we want you to be responsive, but we want there to be safety and soundness concerns underpinning all of the decisions that your institution's making in the short term. And then obviously consider whether or not you should be increasing oversight. We've already been working with institutions whose loan committees are starting to get into much more granular detail as they start to play defense as we move into potentially a default environment. Similarly, Do you have deposit committees that are looking at key deposit relationships, the profitability of those relationships? If you have long-term deposit products, are you being adaptive to the potential of a negative rate environment? Are you being adaptive to the lowering of rates at the Fed level? So that you're not creating economically disfavorable relationships with certain key customers. You want to be thinking about that globally at your institution and really being proactive about that.
To further drive home that proactive refrain, the best offense is a good defense here. So you want to avoid any unexpected financial shocks by closely evaluating key credits and deposit relationships. You shouldn't just assume that what your highest performing clients or your most profitable clients were at the end of last quarter are going to continue to be. Are you continually monitoring whatever sector your clients are in or the products that you're offering and determining if that sector is going to perform as well, if that industry is going to perform as well, if that product will be as in demand as it once was, and once being 3 months ago. So you're going to want to be very proactive in that space and allow your regulator to see that proactiveness within the documents and how you're documenting your decision making. Some of the lessons learned from the last recession, avoid potential under liability claims, kind of look or reassess where your liability is there. Is there anything you can do now to limit that liability? Increase training across the board in areas that you think are going to see spikes. We mentioned earlier that defaults are rising. So like, are you increasing your default training? Are you increasing your collection activity? Are you UDAP training? Things around those drivers so you can show the regulators that you are anticipating this, you deployed the proper or necessary controls. Are you training, in that training, are you touching upon compliance and how it's going to be even more of a necessity in the default environment than at an origination in a performing environment? Are you shifting your FTE capacities? Are you anticipating the need for some of those FTEs to go into certain newer lanes? In 2008, we saw, leading up to 2008, mortgage origination teams were huge. They were giving away mortgage loans to people that could breathe. The underwriting standards were simplistic at the time. As soon as that shifted and you saw the CFPB come around, origination dwindled and your default areas ballooned. Then there are different skill sets. Are you anticipating how to deploy those resources? Are you looking to see, what can be shifted over if need be? What that looks like, what it would require, not only from a cost perspective, but from a human capital perspective. And you're going to want to carefully assess and continually assess capital adequacy and liquidity management through, these times. They're going to want to see that you're thinking that it's on top of mind at all times. And we're seeing certain clients increase capital now, increase liquidity proactively to weather these events that are coming in the future, or what the unknown third, fourth quarter of 20, the first few quarters of 2021. We want to make sure that we're documenting those decisions for the regulators to see. And also not to lose sight of strategic M&A opportunities. Last downturn, we saw a lot of banks successfully come out of it larger and stronger than they were that went in. Those that thought they were in a great position, when the rug was pulled out from underneath them, weren't in such a great position. The opportunities completely changed. It's as if someone shook up the whole industry. You should expect that now. A partner or an acquisition target that wasn't a target 3 months ago might become one. You have to plan for that. Show your regulators that you were looking for it actively.
One of the things we also want to drive home is updating your disaster response program. One of the things, both Craig and I are speaking at a number of conferences in January and February of this year, and of course, everybody's first question is, how should we be thinking about disaster preparedness? Obviously, all of us, since the original FDIC guidance that came out kind of post-Katrina on updated disaster preparedness planning, had some form of disaster response plan. The real question here is one, I don't know that anyone fully appreciated the scope of the COVID-19 pandemic, or necessarily had considered what the long-term effect was. And so one of the things we're really trying to make a point of with our clients is to understand you need to update that disaster response program. We've put some just bullet points here of things you should be thinking about, but really the point here is to think about it globally, which is it not only impacted operations and particularly a lot of smaller institutions, or those without a significant technology presence were impacted pretty dramatically as we shifted to a work from home environment. Our customers were going online and mobile almost exclusively. Everybody's buying things remotely online, maybe using an ATM, maybe not, but we weren't doing branch-based operations anymore. And has your institution adapted to that? Similarly, a lot of institutions, including smaller ones, then immediately had to turn on new online technology products to meet the demands of their customers. And so was your third-party vendor management and oversight function built out in a way that could quickly onboard those, assess them, and manage them? Are you still maintaining service levels? Are you, in essence, able to present proof that, that there is now technology inside of your institution that can be appropriately managed? And does that now change the forward-looking planning of your institution? We saw many, many small institutions, all the way up to large ones, say, we have now seen the capacity that we can take in using technology. We've heard about banks that were below $1 billion in assets who were doing, who may have quadrupled the size of their bank in terms of asset size solely as a result of the PPP loan program. And most of those institutions couldn't do that but for the technology vendors they worked with who had the capacity to onboard and, quote, eat that many applications. Similarly, are you thinking about how your customer relationships have changed? A lot of people who built their institutions on face-to-face, high-touch banking may be re-examining that now. Is that truly the way you're building your brand image? It may still be the case, but make sure you're assessing that looking forward, particularly given the fact that in some ways this crisis has accelerated the digitization of financial services somewhere between 3 and 10 years, depending on what experts you talk to. Similarly, make sure you're rethinking how your balance sheets are working. Any sort of forward-looking assessment, liquidity buffers, key customer activity, all of that needs to be reassessed proactively because that's going to be changing. If you had planned buybacks, stock buybacks, dividends, forecasts, obviously you'll probably be working with your securities counsel, but make sure you're updating that. Perhaps most importantly, really assess your cost and expense controls. There's very little right now that can be done to immediately move the ball on generating interest revenue. You can make some changes, particularly if you're a technology-focused bank, to increase non-interest revenue inside your institution. But just organic lending is not going to be highly profitable for the short term. And so what you can do is then manage your costs and expenses. Are you truly, strategically moving forward on initiatives that make sense post-COVID? Are there certain resources that you weren't using? Meaning, if there were technology resources that didn't get triggered as part of COVID-19 pandemic, you probably didn't need those resources. So can you wind down some of those relationships? Are there other more profitable relationships you should be looking at? And then similarly, make sure you're thinking about your revenue forecasts and your outlooks going forward. Think about how you're going to be earning money when we're talking about potential high default rate environment, low interest margins, and in essence, the ability to make money off of non-interest fee revenue, or alternatively, going out and trying to assess the value of those deposit relationships. And then generally, what does your institution look like post-COVID? Have you sat down and done strategic planning with your leadership team as to what your institution is going to look like 3 months from now? Do you have the infrastructure? Do you have the talent to maintain your competitive advantage if we have this kind of very slow opening that appears we may have and a slow transition back to what we would call pre-COVID normal? Everybody's talking about the new normal. It may be quite some time before we are back to how we were operating in December of 2019. And how does your institution fit in within that relationship? How do you build that loyalty of those customers? How do you build the stickiness? How do you deal with marketing and driving customers when you can't go out and do it? If you were a community institution and you would go out and sponsor events and make presentations, all of that has shifted. And so how are you looking at marketing, reputation? How is all that changing going forward?
And Brad, I think it's not just how you're doing it with that. It's also how the market is doing it from a holistic point of view. Like we were talking earlier about your strategic plan going in through the remainder of 2020 and into 2021. You might not have had, like Brad and I speak a lot about, the digitization of banking and, the moving online, fintech partnerships. That might have not been what your bank was focused on, and you might not be focused on it, currently in the pandemic, but you should be, thinking about what the new post-COVID strategy looks like, not only for you, are you going to be doing that, but are your competitors and peers going to be doing that? Did it force a lot of them into a space, did it speed up that evolution towards a more technology-based banking model? I think it did, and it does, and it's going to continue to do so. But you want to look at that as not only from your own perspective, but also the banking perspective as a whole. Next slide, Brad. Now we're going to shift over to what we're seeing coming out of the CFPB. Love them or hate them, the one thing I do like about the CFPB is how much they publish. Their website is just a trove of information. They publish, transcripts of their meetings, everything, endless reports. Brad and I and our team read them probably a little bit too much, but the point here with this slide is what the director had said during an FSOC meeting in May 15th of this year. Talking about how they were going to manage supervision coming out of the pandemic and going into the pandemic. The first bullet point, she just drove home, we're going to rely on our consumer complaint system. It's an extremely robust system, and it's seen record complaint volume in March and April. We're going to go over that in the next few slides, but she's driving home the point that they're going to continue down the path of leveraging those complaints to focus their supervision and enforcement resources. Also, in the mortgage space, she states that they're hearing a common concern early on in the pandemic. This was, what they were hearing in April and May regarding balloon payments at the end of a CARES Act forbearance period. This speaks to what Brad was talking about earlier about how are you going to, transition off these protections, these consumer protections that are afforded in the CARES Act. Balloon payments are just that. Forbearance payments are just that. When we saw the CFPB come on the scene coming out of the Great Recession, they were driving the use of modification and to modify everyone's loans. We saw HAMP and HARP come out. Banks dove into that, turned the priorities around, and then we saw the regulatory focus on, well, you modified this and put a giant balloon in the end of 3 years. How is that helping the consumer? So it's not just getting the consumer out of the woods in, the next 2 to 3 months or year. It's how to get them back into a performing asset. And balloons, generally from the regulator's perspective, are not the way to do that. They're going to be looking at that very closely. This last bullet point here, where she stated the Bureau has developed a new targeted supervisory approach called prioritized assessment. This, as far as I know, is the only time that the Bureau has actually spoken about the prioritized assessment. We've seen a couple of clients receive them. And what's concerning here is that she states that it's going to focus on those markets and institutions that pose the greatest risk of consumer harm as a result of pandemic-related issues. So if you've received that notice, know that the Bureau has it in their internal narrative that your institution, by default, is either working within spaces or markets that the CFPB views as holding great consumer risk, or your institution itself is posing a great consumer risk, maybe from an old CMS review or your compliance rating or whatever it is. The Bureau has now believed that you are moving up the rankings in their own internal risk assessment. The CBA has requested further clarification on what these risk prioritized assessments look like, how it differs from their modules that are currently in place. We haven't seen a response. The Bureau hasn't issued any formal guidance on it. We're seeing just through our practice that they look very much like the normal exams. It's just that you now have a little bit more line of sight into what may be driving those assessments that are coming out the gate early. Like the Bureau shift up the exam schedule and are now looking at who they believe to be a higher risk than someone who they believe was managing risk very well going into the recession. Next slide, Brad.
Yeah, great point, Craig. And, one of the interesting things we're seeing as well is there's kind of two trends within the CFPB complaint databases. And as Craig mentioned, great leading indicator of issues. And so when we look inside of the complaint database, we're seeing record numbers of complaints. And so in March and April, for the first time, the CFPB received over 42,000 complaints, which is more than they've ever had in their complete history. Interestingly, most of those additional complaints not related to coronavirus or COVID. That's not to downplay that, but what we're learning from that is if 4,500 of those complaints included coronavirus-related keywords, then you can extrapolate out that 38,000 of those complaints did not specifically reference COVID or coronavirus. So there's two key takeaways from that. One is compliance control systems may be struggling at institutions right now. We're working remotely, we're working in a non-face-to-face environment, and so there may be stresses being put on your compliance systems, which is why we have a big spike in generalized complaints. In addition, we're seeing a spike in COVID complaints as well. And so we've kind of taken some excerpts here, put them here for your reference, but if you look at where the problems are, it's tending to trace those leading indicators we talked about in the St. Louis Fed research, which is the complaints right now are largely focusing on mortgage and credit cards, meaning that is where consumers are, quote, hurting the most. Interestingly, among mortgage complaints, the number one complaint, and I think this makes sense to everyone, is consumers are struggling to pay their mortgages right now. Somewhat interesting, given the additional support for unemployment as well as the additional unemployment benefits that the federal government has put in place, this may be largely a commentary on some of the systems that are not actually deploying these funds out to consumers. But as we talk about kind of squaring that with what the Mortgage Bankers Association is reporting on forbearance and default rates, we're probably going to continue to see significant forbearance requests in the consumer mortgage market. Biggest issue, obviously, with credit cards continues to be unauthorized transactions or issues with purchases. Again, this is really reflecting a shift in the economy and the U.S. public right now, which is more people are buying online, more people are doing business non-face-to-face. And as we did in the presentation last week that Samar and Liz presented, we've seen a huge spike in COVID-19 related fraud, particularly targeting those who may be new to using technology-based financial services. So we expect that to continue.
The one thing I would add to that as well, when you see these spiking complaints, we've been in a performing credit market for the last couple of years, as we exited the Great Recession. A big thing that I don't want people to forget is the reputational risk around the CFPB complaint portal. As you're starting to see these complaints increase, you'll start to see more and more financial services reporting stories come out regarding your institution. Just yesterday, we saw Brad, Liz, and Samar and I were talking about a story that's coming about Citi credit cards. Consumer Reports had dove into the complaint portal and just pulled Citi's complaints and matched it up in narrative with their peers. The data, as raw data that Consumer Reports pulled, wasn't very complimentary to Citibank. So you start to see that snowball in the media. We saw it hit larger media institutions this morning, and you see it with your complaint volumes in individual spaces. As the default rate rises, you're going to start to see complaint volumes rise, and you're going to start to see the institutions that carry heavy proportions of that complaint volume be called out in the press. To manage that reputational risk, you have to be very much on top of your complaint program. A lot of banks, surprisingly, still have not prioritized their complaint programs after the CFPB rolled out the programs, especially if you're a bank sitting under $10 billion and you're going to cross that $10 billion threshold. It's something you want to heavily focus on. The CFPB complaint process is, a large portion of your CMS, a large portion of your reputational risk. And to that end, we're going to shift towards some of the graphs that you see here on your screen. The CFPB report that Brad mentioned in the prior slide, it's hyperlinked in the prior slide when you get these materials, but it's almost like an outline of where the CFPB will be focused. You see, like I said earlier, their CFPB publishes nonstop. Their publishing around consumer complaints is actually helpful as a roadmap as to what your CMS could be focused on and what you as an institution should be focused on. You see the complaint of the COVID complaints buried within each product line here. So mortgages is seeing a very heavy activity or heavy COVID impact. Credit card is seeing a very heavy COVID impact. And you're seeing the top COVID issues reported by consumers within the product line. You should be taking that and seeing if you have these similar issues or seeing if you have these issues within your product lines as an institution and how you can address that. And just don't do it, document it. You want to create as much goodwill with the regulator as humanly possible. This is one way to do that. If you're rolling out a new product, or if you have a product that, or if you're heavily in one of these spaces, use this data. State that the reason why you're looking at the complaints or why you pulled a certain complaint category into an escalated category for the COVID-19 era is because you knew that the market itself was experiencing a spike or an outlier in this space, and you want to see if it was impacting your institution. That goes a very long way with the EICs and you know, calms their fear of any harm that they're not seeing, knowing that you're managing in such a manner. Next slide, Brad.
Yeah, and as we look at the CFPB reports, you know, we'll kind of leave this one with you. But as we look at the weekly trends in terms of how these complaint ratios are changing, you know, a lot of this is what we would expect. Still a lot of complaints related to prepaid cards, consumer credit reporting, but then a big spike on money transfer and virtual currency. And so, you know, as you're going through your CMS, make sure you're thinking about where these complaints are happening and making sure it's staying responsive as they go through. And so,
great opportunity. Sorry, Brad, go ahead.
No, go ahead.
It's a good opportunity too to get some board reporting in. If you want to show proactiveness within your board interactions, start to show that your compliance and risk departments are well aware of what's going on in the market space with consumer complaints and where the industry is trending. This is an opportunity to showcase that for the CFPB and put that in your board material. It's also a good way to make your COVID response more robust. This is you're being proactive. You're looking at these spikes.
And so one of the things we'll touch upon this next group of slides, just because it's become such a lightning rod issue, is the Paycheck Protection Program that many institutions rolled out. We're seeing both interest on the Hill as well as from the regulators and now Department of Justice related to the PPP program. And so just as we're thinking about this proactive response to crisis, how we're responding to it, this is a great opportunity to show that you're adapting in real time. Obviously, this program was rolled out extremely quickly. It was rolled out in such a way that many institutions were simply being reactive to it. And so it's a good way to show that you can manage that type of change in very short order. And so make sure you're going back now, if you didn't do it originally, and really documenting how you thought about the Paycheck Protection Program, how you were going to deploy it, how you were going to determine limits and volume, how you're going to prioritize folks. Because at the end of the day, OCC here clearly telegraphing that they're going to be examining how you rolled your PPP program out for principles of safety and soundness, as well as, and a really important point here, fair access and fair treatment of borrowers. If you're not being proactive on your ECOA issues, your Equal Credit Opportunity Act issues associated with the Paycheck Protection Program, please hear us. Writing is on the wall. Congressional representatives and senators are focusing upon this. Regulators are focusing upon this. There will likely be very difficult examination of how you deployed your program, how you prioritized individuals within the program, who you decided to offer it to, and whether or not that's reflective of your communities and your assessment areas, and whether that's reflective of your existing commercial loan portfolios. Really make sure you're going back, just like we talked about earlier, and documenting all these policies and procedures.
And Brad makes a really good point. Going back and documenting and being proactive in this space doesn't mean you should be doing it or you should have been doing it as the PPP was rolling out, but you're not, just because the originations are winding down doesn't mean that the PPP issues are behind us. They're just starting. To Brad's point, I hear us now, I don't think we could say this enough or loud enough. It's going to be a focus in your next exam, especially if you did outsized origination volume compared to what you normally would do in the 7A space. So even though the originations might be winding down, you're entering forgiveness. You're entering a servicing, part of the life cycle, and it's much easier to go back and document that now. It might seem like a bit of a high expense or from a FTE allocation to have someone working on that when they're not originating now, but we cannot oversell this enough. It's going to save you a lot of pain if the EICs come in and you're looking to gather those controls or looking to gather the evidence of your compliance or what you were thinking at the time a year from now. If you're trying to rebuild this in 2021, it's going to be a problem. This is from the CFPB blog post. Again, like I said before, the CFPB publishes everything. Here we saw the CFPB's insight into how they were viewing the PPP program, and they talk about the CARES Act, and specifically that ACOA extends to small business loan originations like the PPP and those under the CARES Act. We highlighted down at the very bottom there, small business owners who believe they were discriminated against based on race, sex, or other protected category can submit a lending discrimination complaint online. Again, this goes back to what we were saying about the complaint volume. The CFPB is focused on this. They're actually begging people to file the complaints within the small business space. So you can expect that they're going to be looking for that as soon as they get in there for your next exam.
Yeah, and kind of along that same line, and we'll cover these fairly quickly. The CFPB also came out. Make sure you're aware of this. We saw this catch a number of institutions. Is adverse action notices do apply to your PPP loan determinations, meaning that if you did not or were not able to approve an application for a PPP loan, the normal adverse action notices do apply, and you need to be sending appropriate adverse action notices compliant with Reg B to those impacted customers so that they understand the basis of that denial. And so just be aware, if you aren't, CFPB did come out with guidance specifically addressing that issue under Reg B. And then kind of as we close out the PPP, just remember, we've got three things running in parallel. You've got the civil lawsuits that are pending all across America. Over 5,000 institutions have been named related to the use of agents and the agent fee cases. You've also got a whole series of cases as well as likely regulatory examination over how you deployed your program, fair lending concerns associated with it, and the prioritization of customers. That's area number 2 that's running out there. Make sure you're staying abreast of that and staying ahead of it. And then third, the Department of Justice civil investigations. Number of banks have gotten CID, civil investigative demands related to their PPP program. Obviously, the Department of Justice already has a task force that's actively looking into fraud, and that fraud could be fraudulent borrower activity, that could be fraudulent lender or agent activity. And so make sure as you're doing these certifications, you're really being diligent in terms of exactly complying with the certifications that SBA and Treasury have been imposing on you, so that it is shown that you are adequately disclosing where appropriate, you've got the appropriate risk controls around the program, and really looking to avoid any sort of fraud associated with the program, because you've got that third bucket as well that's coming through related to Paycheck Protection Program.
We also want to touch on your ERM functions. It's not just your consumer compliance and CMS that we're looking to prep you on for your next exams, but also your ERM controls. You're going to want to look at your KPIs and your KRIs to make sure that, are they still relevant? Are they still the most efficient way of forecasting what your risks are going to be? How have they changed under COVID-19? You don't want to wait for a regulator to ask you questions with a finding within a space. You want your ERM to kind of telegraph those changes ahead of time, or at least show your intent to do so. We're expecting to see increases in consumer complaints, legal violations because we're moving into a default, new vendor onboarding, new products, PPP that Brad was just talking about, Main Street lending, data privacy issues are all stuff that we're going to we believe are going to explode in the next 12 to 24 months. Your ERM should be looking at this. Your risk assessment should be looking at this. And you want to make sure that the monitoring and reporting in place is working efficiently, that everyone's getting these, that business units are returning the questionnaires from your risk department timely fashion. You're not extending these out. This is not a time. I know that the business units are very busy. They might be putting off responses to your ERM heads or whoever has that function in the risk silo, not updating their open risk ratings or their open findings. You do not want to show a regulator that you allowed those deadlines to pass, that your response time from your business leads were extended. They're going to be saying now that they don't have the time or the resources to dedicate to a response. Your job in the risk department right now should be to make sure they stay on track, make sure they're responding timely. It's even more so important because the regulators are going to be looking for how quickly and how efficiently you were responding to these issues. They're not going to care that the business units were overwhelmed with a work from home transition, a new product, the PPP origination, that they were working 24 hours a day, submitting and processing those applications. It's your job as a risk manager, if you're in the risk management department, or if you're in a senior management position, or if you're on a board, to question these ERM responses to make sure that they're being timely delivered and escalated to your board for reporting. Next slide, guys.
Yeah, and then similarly, while we're talking about enterprise risk, we also talk about our compliance management systems, which is, make sure that you are continuously updating them in response to COVID. Probably this is the greatest opportunity if you're in the compliance function inside of an institution to show that you have responsive compliance. Make sure that as we think about all these aspects of compliance shown here on the slide, that you're updating them, that you're monitoring, that you're management. All of that is changing in response to changing economic conditions external to your institution. It really, I think, can be viewed as an opportunity to really show off your internal compliance resources. Similarly, make sure you are specifically dealing with regulatory change management. It's the biggest risk generally in compliance is as we change services, we change products, we change how we are relating to our customers. Make sure that the various players are involved. We've already seen some fallout where, for instance, with the Paycheck Protection Program, things were being run out inside of a business unit without going through compliance, without going through risk. And it's leading to some issues right now, meaning that certain individuals were not consulted. Understand you have a CMS for a reason, and you need to be complying with it as you move forward and start to change in the next few months. And Craig, I guess I'll take this one as well. This is your basic risk management and assessment function, but understand that all of these bullet point items that are referenced here have been compressed. Many of us looking back over the last 2 months realized that this process that's shown here that could have taken traditionally, 6 months, 9 months, oftentimes was compressed into 2 weeks or less. Many folks who had mortgage portfolios trying to figure out how to accommodate those folks on a 2-week notice. Those of you who participate in PPP were putting that live in 2 weeks, 3 weeks, 4 weeks. If you had significant credit card portfolios, you were adapting to those in real time. And so we didn't go through our traditional compliance management functions that are shown here. All of this was compressed into a very short period of time. And what you need to take away from this is the regulators are not going to give you passes on this process. Make sure that if you're talking about any of the programs you've put in place in the last 2 or 3 months, you can document this entire process, even if it's potentially retro, going back and documenting it now after the fact, but you want to be able to document that complete process. The pandemic, in essence, did not give you a pass out of going through the system.
And missing it, if you didn't do it in real time, that's not a failure of your CMS. The only way to leverage the speed of which these issues impacted those in the financial services industry, I believe, is going to be using it to leverage the narrative, saying that we got this in quickly, so we didn't ignore it. It just might have picked it up in a different cycle. 2 slides back, Brad had that graphic on there showing the life cycle of a compliance management system. If it picks it up in the next the next part of the CMS life cycle, it's still working. And that's what the regulators want to see. They don't want to see that, they do want to see that it was picked up as soon as possible, but just because you may have not have made those inroads immediately, it's not something that's behind you. It needs to be picked up in the next portion of a CMS. This graphic that we have on the screen here is updates to risk assessments. We want to make sure that you're aware of how the current pandemic can impact your risk assessment. Every single one of those arrows is pointing to a part of the methodology that you should be utilizing within your risk assessments that's going to be impacted by the pandemic itself. So your risk assessments that were completed in January, February of this year, the fourth quarter of 19, all would have changed. You should be updating these. You don't have to update them all at the same time. That is something when you're speaking to the regulators so you feasibly can't do. A bank can't say we're going to redo the entire risk assessment in the month of May. But you should be updating them as they come through to account for the impacts that we're seeing from COVID-19.
Yeah, great point, Craig. And this comes from our risk assessment methodology we use with financial institutions. And all of these are dynamically scored as we go through this process. Just something to really remember that, all of these pieces are being right now changed as a result of COVID. And so if you're not updating your risk assessments, if you're not looking at mitigation and effectiveness and the current risk trends, it's something that an examiner could easily point to and say, hey, there's a problem. Similarly, make sure your compliance monitoring is being adapted and updated to respond to COVID-19. Perhaps the most important aspects of that is making sure that as we're all working remotely and responsibilities are changing, that we're not overlooking these basic components of a properly functioning CMS. One of the things we've seen a lot of challenges with is making sure that prompt corrective action is being taken, meaning if you do identify problems, which candidly we're going to have a lot of problems here in the near term. A lot of these things were rolled out very quickly. We likely will see issues come up. Make sure you're taking prompt corrective action and then documenting it so that you can then demonstrate it to your examiners. One of the things we always drive home to our clients as we're trying to respond to examiners is it's very few times examiners can criticize you for not being perfect. Very few institutions never have any violation of law, always do everything perfectly, have zero complaints from any customer. Rather, there is some business risk associated with the financial services sector. You're going to have certain things you miss, and instead what the examiners are going to focus on is how you respond to it and how you adapt to it.
It's a great point, Brad. The one thing I would drive home there too is the hectic nature of, or the chaotic environment that COVID has forced upon us. One opportunity to take out of that is everything is changing so much in all of the business lines and all of the controls. It is an opportunity to showcase how they are talking to one another, how one control is informing the other. We have a lot of institutions that, the EICs will come in and say, show me how this is not just a check the box control. Your risk assessment, are you actually informing it from other controls? In an institution that has very little change, if they're a very conservative product suite, or they're not exactly a higher risk bank, it's difficult to show that. This is an opportunity where there's so much change and so much movement that it will be easy to showcase how your monitoring and testing picked something up, how you identified something that was missing in the policies and procedures. There's just a lot of volatility there, so it should be an opportunity to show the movement in the CMS. And the flip side of that, if you don't show the movement, it's very easy for the regulator to come in there and say, this is a check-the-box control, it's meaningless. You didn't even account for, 50 different guidances that came out from your various regulators. The slide that we have up here are CMS policies and procedures. We just want to outline some of the areas that you should be focused on. Coming out of the last downturn, we saw that these were heavily looked at by the regulators. Again, we said earlier that we've been in a performing environment for so long. It's not that the regulators were ignoring these sections, but you might have noticed that their time and dedication to the individual modules that oversee these specific areas may not have been getting the attention that they would have gotten in 2010 and 11 and 12. We're going to see a revert back to those times when these were the spaces that they were heavily focused on.
When we talk about that compliance analysis, make sure that we're kind of taking that global look and make sure you don't lose sight of that basic compliance analysis obligation than the reporting functions. Meaning, are you still validating data? Are you checking for accuracy and comprehensiveness? With a lot of folks not working in person at institutions, that can easily fall between the tracks. Similarly, make sure that with the pace that we're working on, you're not missing deadlines, you're not missing submissions. Similar to what Craig mentioned a few moments ago, if you're doing corrective action plans, stay on top of those deadlines. If you're seeing issues that are developing, make sure you're staying on top of the individuals within your institution to hit those timelines, because in essence, the further we get past COVID, hopefully, the less of a, quote, pass an institution will receive for how they were trying to respond to it. And then similarly, if there are issues that develop, meaning there were reporting errors, breakdowns, your QA had failures, your quality assurance function had some failures, there were some timeliness issues, make sure you're documenting why that was and what your plan of action is to remediate it. Same thing on the compliance side, document. They don't expect perfect, but they do expect responsiveness. And so make sure you're really staying on top of that.
Next thing I wanted to touch on was your TPO, your vendor management controls. We do have, some of the pillars of a quality TPO program, but we do want to mention here that you're most likely in an environment where you're going to be heavily relying on vendors a little bit more than you normally would. If you're shifting into a space that you normally wouldn't be, if you're accelerating your customer experience upgrades, like if you're moving more to a digital channel or moving stuff online, you're going to be partnering with vendors that you haven't partnered with before. Or if you're just seeing volumes of people utilizing your current online offerings, you're going to see a burden on those vendors. You want to make sure that your oversight of them is responsive to your understanding of the demands that are being placed on the vendors, just from a volume perspective or from a shifting environment. Just as COVID-19 is impacting your institution itself, it's also impacting the vendors. Your third-party oversight program should acknowledge this and put in controls for that oversight. The EICs are going to be looking at that very heavily when they come on site for your next exam. Now's your opportunity to make sure you're placing that narrative in there for your TPO program.
Yeah, and on that point, Craig, a great one. Really make sure you're able to document your diligence and oversight, especially as we start outsourcing functions in a technology environment. Really make sure you can go back and say, no, we manage this appropriately. If you were outsourcing parts of your PPP program, if you were, using additional technology to help individuals apply for, forbearance programs, what have you, make sure you can document that third-party oversight, because ultimately you as the institution are responsible for it. Along that line, just for your future reference, here are, if you look at what the FDIC deems to be highest risk areas within a third-party oversight function, the ones we've starred here are all potentially directly impacted by COVID-19. Meaning, not only is this slide the highest risk categories according to the FDIC, but those that we've put the little star next to are all potentially specifically impacted by the changes over the last few months. And so make sure as we go into a potential default environment as well as the COVID-19 pandemic, you're really putting appropriate resources into each of these categories, because it's very easy for your examiner, whoever that may be, to come in and say, okay, these are the highest risk categories, and we're really focusing on these, and we want to see how you adapted to the post-COVID environment, particularly on these that are starred.
It's interesting, Brad, too, the areas that you starred there are the correlation to the complaint narrative that the CFPB put out last month. It almost lines up line for line, like this is where they're seeing increases in complaints, and this is where they're going to be focused on. We see it repeated again and again and again. It's just something that we can guarantee is going to happen. Next slide. We wanted to touch on mortgage servicing as well. If you learned anything coming out of the last downturn, mortgage servicing, the oversight was intense. If you're in the mortgage space now, if you rely on private label or sub-servicing, if you're thinking about moving a default portfolio, because the cost of default servicing is much greater than a performing servicing portfolio. A lot of entities decide to sub-service their defaulting loans. If you do that, you're going to be scrutinized by the regulators. You're going to want to diligence any private label or subservicer very closely. You're going to want to see how they handle complaints, as the complaints are escalated up. They're going to want to see a very, very strong MSA with the subservicer or the private label servicer. You're going to want to check your delegated authority. What authority does the subservicer have? Can they approve modifications? We're expecting a wave of modifications to come in over the next 12 to 18 months. What can the vendors do for approval? Are they in line with what your offerings are? Does the lack of training at the subservicer for your own offerings cause unnecessary consumer harm or delay in their processing? And then eventually this will boil down to property preservation and foreclosure vendors. As you saw the default rate rise and the modifications work through, you then saw regulatory scrutiny in your property preservation departments and your foreclosure vendors. A lot of liability here. If you're not properly managing them, the regulator will go in there and hit you again and again and again with multiple MRAs. You're going to want to learn from 2011, 2012 and see what the regulator is focused on and make sure your program is up to snuff for the next go round.
And then last thing we'll touch on, and we hate to kind of keep piling on it as though the killer hornets and COVID and the asteroid passing next to Earth were not bad enough. We're also in an election year, and so potentially there could be changes at the administrative agencies, could be a change in terms of the approach to the regulation of financial institutions. One of the things we kind of put here are things just to be considering as you start planning, as you move forward is, there are potentially some systemic changes that may occur if there was a shift in the administration. Most analysts who are looking at this from the investment banking world have said what may be more important is whether or not there is a divided presidency in Congress. However that division occurs as opposed to consolidation all within one of the parties. But, understand that, there are some policy positions that have been articulated previously, within the Biden campaign that if there was a shift from the Trump administration to a Biden administration, you need to be planning for how will you deal with the reversing some of the deregulation we've seen. How would you respond to potentially a more proactive regulatory environment? Reversing some of the recent reinterpretations of certain rules under Dodd-Frank. How will you, if you're in student lending, how will you respond to the proposals for eliminating certain aspects of student lending? If you're in the credit card industry, how will you respond to certain changes that are being advocated to change the bankruptcy procedures associated with credit cards? And how will you adapt to increased cost of labor and potentially decreases in bank consolidation, meaning there have been some advocates within the Biden campaign and some of the advisors to the Biden campaign who have advocated for trying to block bank consolidation while at the same time increasing bank capital and liquidity. These are all extremely far-looking, but it is something to be aware of that as you are planning and you're adapting your compliance management system, your bank's go-forward plan, your bank's strategic plan over the next few years, that you should really be taking into account that potentially a lot of what we've been seeing for the last now 3.25, 3.5 years may significantly change if there's a change in administration, particularly if there is a full change in both the control of Congress and the presidency. One of the things that American Banker pulled out, and just something to be aware of, is if we look at the current